Let's get right to it. There is a critical mistake that most people make with their money, an unforced error that quietly costs them an absolute fortune. They're trying to build wealth, but they're doing it in the wrong order. It's like trying to build a skyscraper without a foundation. Today, we're going to map out the correct path, the mathematical roadmap to building real, lasting wealth.
So I want you to picture this. Think of your entire financial life as a bucket. You work hard, you pour your income into it, hoping it'll fill up over time. But here's the problem. For most people, that bucket is riddled with holes. Giant, gaping holes. Things like high-interest debt, crazy taxes, and just no real plan. They're draining your money away faster than you can pour it in. Our job today? It's to patch those holes, one by one, in the right order.
Okay, so here's the game plan. We'll start with the leaky bucket problem to see just how much this matters. Then we'll patch the biggest leaks first. After that, I'll show you what I call the free money glitch. From there, we're going to declare war on taxes, and finally, we'll explore the final frontier of wealth building. Let's go.
All right, Section 1, the leaky bucket problem. And this really gets to the core of it, why the order matters so much. Look, the stakes couldn't be higher. Getting this wrong isn't just about ending up with a little less money. No, it's about actively hemorrhaging a huge chunk of your potential wealth to things you can absolutely control.
So you might be thinking, come on, does the order I invest in really matter that much? I'm saving, I'm investing, isn't that good enough? And look, it's a totally fair question, but the answer is a hard, unequivocal yes. This isn't just some friendly suggestion. This sequence is the entire strategy. It's literally the difference between a secure future and one filled with financial stress. And if you want proof, here it is. Just look at the raw numbers. Over 30 years, the exact same amount of money invested, but in a different order. Following the right steps, using tax-advantaged accounts, gets you to almost $950,000. The wrong way? $700,000. That's nearly $250,000 gone, just vanished. That is the price you pay for getting the order wrong. It's staggering. Okay, on to Section 2, patching the first leaks. This is all about building that solid foundation. Now, I gotta be honest, these first steps aren't the sexy, get-rich-quick moves, not at all. These are the boring, but absolutely essential fixes that prevent financial disaster.
Step 1, before you even think about investing a dime, is the safety net, an emergency fund. Think about it. What happens when your car breaks down, or you get a surprise medical bill? Without this cash cushion, you're forced to sell your investments probably at the worst possible time. It's a psychological backstop. So where do you start? Just get to $1,000. That's your first goal. From there, you build it up to 3, maybe 6 months worth of your essential living expenses. This is non-negotiable.
Yeah, this quote just says it all, doesn't it? Investing while holding high-interest debt is like trying to run a marathon with a backpack full of rocks. That's exactly what it is. It's this crushing weight that makes any real progress feel impossible because you have this guaranteed force actively working against you 24/7. 22%. That is the average interest rate on credit card debt right now. Let that sink in. This isn't just a loan, it's financial cancer. It grows and spreads faster than any investment you could realistically hope for. But here's the flip side. When you pay that debt off, you are giving yourself a guaranteed 22% return on your money. No risk. I mean, the greatest investors in history would kill for a guaranteed 22% return. And it's right there for the taking. Moving on to Section 3, the free money glitch. Okay, so we just talked about how you have to destroy that high-interest debt first, right? Well, there's one exception. A powerful little glitch in the financial matrix. It's an opportunity so good, so mathematically undeniable, that you actually pause the debt repayment to grab it. And here's the glitch. Your employer match, in your 401k or similar plan. This is it. This is the only reason to divert a single dollar away from your debt avalanche. Why? Because it's literally free money. To not take it is to just leave a pile of cash sitting on the table. Let's just break down the math. It's so simple, it's almost absurd. On one side, you have high-interest debt, which is a guaranteed loss of around 22% a year. On the other, you have your employer match, which is a guaranteed return of 50 or even 100% instantly. There's no contest. So here's the play. You contribute exactly enough to get the full match, not a penny more, and then every other spare dollar goes right back to war against that debt. All right, Section 4, winning the tax war. So your emergency fund is built. The high-interest debt is gone. Now the game changes. We're moving from defense to strategic offense. And our main enemy? The two silent killers of wealth, fees and taxes.
It's time to shelter your growth. So here's a really crucial point. Once you've gotten your employer match, your next investment dollar should not go back into that 401k. And you might be asking, why not? Well, because many of these plans are infested with what I call termites, these hidden, high management fees that just chew away at your returns year after year. The solution? You take back control. You open an IRA, an individual retirement account, where you can find much lower cost options.
Okay, so you've opened your IRA. Now you have a choice to make, Roth or traditional. Look, it can seem complicated, but it really boils down to one simple question. When do you want to pay your taxes? If you think you're in a lower tax bracket now than you will be in retirement, you go with a Roth IRA. You pay the taxes now, and all that growth and all your withdrawals in retirement are 100% tax-free. If you're a high earner now, you might want the tax deduction today, so you choose a traditional IRA and pay the taxes later.
All right, next up we have what is, without a doubt, the most powerful and criminally underutilized investment account in the entire country. I'm talking about the Health Savings Account, the HSA. It's not just for medical bills, it's a secret retirement building powerhouse, a true Swiss Army knife.
And here's why it's so incredible. It's the only account that gives you a triple tax benefit. Check this out. 1, the money you put in is tax deductible. 2, it grows completely tax-free. And 3, when you take it out for qualified medical expenses, it's, you guessed it, also tax-free. Nothing else does this. It is an unmatched weapon in your financial arsenal.
And that brings us to Section 5, the final frontier. So listen, only after you've done everything we've just talked about, the emergency fund, the debt is gone, you're getting your match, you're funding your IRA and HSA, only then do you get to this stage. This is for people who have built that rock-solid foundation and are ready to hit the accelerator.
So what's the move? It's simple. You go back and you max out every single tax-advantaged account you have access to. We're talking about filling that IRA to the brim, that's $7,000 for 2025. You're maxing out your HSA, over $8,500 for a family. And then you go back to that 401k and you shovel in money until you hit its limit of $23,500. If you can do all this, just know you are operating in the top tier. You're in the top 5% of savers in America. And only now, after all of those tax-sheltered buckets are completely full, only now do we step into the Wild West. We're talking about the standard taxable brokerage account. The gloves are off here, you have total flexibility, which is great, but it's also where the undisciplined investor can get into a whole lot of trouble.
The biggest danger, the reason this account comes dead last, is a concept called tax drag. See, in this account, every time you get a dividend, you pay tax. Every time you sell something for a profit, you pay tax. It's this constant, relentless friction on your returns. It's exactly like trying to run a race while someone is pouring sand in your shoes. It just slows everything down.
So when you step back and look at this whole order of operations, you see what we're really doing. We're building a solid foundation, brick by brick, not a flimsy house of cards that can be blown over. Look, I know some of this stuff is boring. It's the eat your vegetables part of finance. But I promise you, following this order creates a resilient, strong financial future. And your future self, the one who is living a comfortable, stress-free life, they are going to thank you for doing the boring stuff first.
So there you have it. The bucket is patched, the foundation is solid, the roadmap is clear. You now have the blueprint. The only question left is, what are you going to build with it?